Today, we'll learn the basic steps for preparing a cash flow statement. Businesses use cash flow statements to understand how their cash inflows compared to their cash outflows. The basic concept is to reconcile our bottom line of income statement, net income, to the change in the top line of our balance sheet, cash. Reconciling cash and net income is an important process in understanding what happened to our cash. Activities that affect cash balances fall into three categories: operating, investing, or financing. The cash flow statement will contain a section for each category. Within each section, we will compute the net cash flow. Finally, we will combine the net cash flows from each category into one singular number. Let's tabulate a cash flow statement for Great Tools, a business that sells great tools. Before we continue, let's confirm the change in cash balance from the start of the period to the end of the period on the balance sheet. Great Tools had $65,000 at the end of the period and started with $55,000. This means Great Tools had a net cash increase of $10,000 over the period. Remember this $10,000 number because we will use this number to confirm whether our cash flow statement is accurate at the end of the exercise. Let's work on the operating system category first. We will use the indirect method, where we start with net income and list adjustments to derive the operating cash flow to determine the net cash flow. Because we are creating a cash flow statement, we need to remove any activities from Great Tools' reported net income that are not truly held in cash. Say Great Tools incurs a depreciation expense of $7,000, which is a non-cash expense incorporated into the net income. This expense needs to be added back into the net income in order to calculate the operating cash flows. We must also consider Great Tools' balance sheet to determine the net cash flow of its operating activities. Say, for example, that Great Tools reports an increase in accounts receivable of $2,000 from $15,000 to $17,000 during the year. This $2,000 is included in the sales revenue, which is part of the net income, and must be subtracted from the net income because this cash from customers has yet to be received. Great Tools also had a prepaid rent increase of $1,000 during the year. In prepaying $1,000 towards rent without incurring a corresponding rent expense, Great Tools reduced the amount of cash available by $1,000, but the net income was unaffected by this transaction. To adjust for cash being lower by $1,000, we subtract the increase in prepaid rent from the net income. In our cash flow statement for the operating category, we now have the following adjustments. We added back in a depreciation expense of $7,000. We deducted an increase in accounts receivable of $2,000. We deducted an increase in prepaid rent of $1,000. This means our net cash flow for the operating category is the net income plus $7,000 minus $2,000 minus $1,000, which equals $61,000. Thus, $61,000 is the net cash flow for operating activities. Depreciation is shown in the operating activities as an add-back to net income. Now, we'll move on to the next category, investing activities. Investing activities are related to the Great Tools property, investment purchases, and equipment they own. They are the changes in the long-term assets on the balance sheet. From Great Tools' balance sheet, we know that Great Tools sold $20,000 worth of investments during the period. This is a cash inflow. Great Tools also purchased land during the period and paid an actual cash value of $18,000. This is a cash outflow. To find the net cash flow for the investment activities category, we combine the gain of $20,000 with the loss of $18,000. This is a net increase in cash flow of $2,000. Our third section of cash flow statement covers flows relating to finance activities. Financing activities are the changes in the long-term liability accounts and the equity accounts, except for net income. Borrowing money and selling stocks, as well as repaying loans and dispersing dividends to shareholders, are common activities affecting cash flow. Once again, we will refer to Great Tools' balance sheet for this information. According to the balance sheet, Great Tools issued $4,000 worth of stock to investors. This is considered a cash inflow. At the same time, Great Tools paid out $12,000 worth of dividends to stockholders, which is a cash outflow. To find the net cash flow in the financial activities category, we will combine a gain of $4,000 with a loss of $12,000. The net result is a decrease in $8,000 in cash in the financing category. The last step in creating Great Tools' cash flow statement is to combine the net cash flows in all three categories and then compare it to the net cash change in cash flow as listed on the balance sheet, which we identified at the start of this exercise. Remember that $10,000 number? This is the number we hope our net cash flows in each of the three sections will sum to. In our fourth and final step, we will combine our net cash flows of a net increase of $61,000 in cash from operating activities, a net increase of $2,000 in cash in investment activities, a net decrease of $8,000 in cash in financing activities. This tabulation results in a net cash increase of $10,000, which matches what is reported on Great Tools' balance sheet. This reconciliation between the balance sheet and the actual cash flows for Great Tools means our computations are correct. Reconciling the net income in the income statement, earned during the entire year, and the changes in the cash balances from the beginning to the end of the year is what the statement of cash flows is all about. Whew, that was a lot of arithmetic. Now you know how to create a cash flow statement, an important way to evaluate how a business functions. Great work.